Good afternoon, I'm John Quigley from Berkeley, and it's my pleasure to welcome you to this symposium on the mortgage meltdown, the economy and public policy, organized jointly by UCLA's Ziman Center and the Berkeley Program on Housing and Urban Policy. Stuart, Gabriel of the Anderson School and I started planning this joint venture sometime last January. And at that point, it had been clear for several months that national housing prices had experienced modest declines for the first time in 15 years. It was also apparent that these price declines were largest in California, where there had been the biggest run-up in the early part of the century. But the full implications of these declines were not yet clear, and of course they're not yet clear even now. From the beginning, we were really fortunate that so many talented people were willing and indeed eager to participate in this symposium. Speakers, panelists, discussants, and as we discovered, as members of the audience as well. We hope this is the first in a series of collaborations between UCLA and Berkeley, and we envision perhaps an annual conference sponsored by the research institutes at the main campuses of this university. On the first day of the symposium, we'll rely on the expertise of people who've been intimately involved in the operation of mortgage and financial markets, assembling mortgage securities, trading them, overseeing various stages of the mortgage process, observing and regulating these activities, and managing the human resources that are all a part of the process. Our panelists have experience in private banking, venture capital, Securities and Exchange Commission, OMB, the FDIC, Department of Housing and Urban Development, and the FHA. And we'll discuss the future of the housing finance system and the role of government in that system. On the second day of the conference, we'll rely on the expertise of 6 academics who've agreed to write detailed papers on aspects of the mortgage and financial crisis and what to do about it. These papers are all available now, by the way, at urbanpolicy.berkeley.edu. You can download them and study them this evening. And we have a dozen of some of the most talented and qualified academics as discussants. Our guests are household names, at least within the tiny world of academia. Beyond this, we'll have the perspectives of 3 senior officials with different vantage points and public responsibilities for dealing with these issues. The President of the Federal Reserve Bank of San Francisco, the Chairman of the Board of Governors of the Federal Reserve, and the Chair of the Committee on Banking and Insurance of the California State Senate. We also know there's a great deal of expertise here in this audience, so we've tried to organize things so there'll be lots of opportunity for interaction and for exchange. Before turning the proceedings over to my partner from UCLA, I've got a couple of housekeeping announcements. First, red strip tickets. They're necessary for the entrance to the session tomorrow. Everyone got a little red ticket as a part of your name tag. Don't lose your red ticket. You can't be permitted to enter the Bernanke session across the way tomorrow without your red ticket. And we don't have any capacity to replace them. So they're negotiable, but they're required. Speaker seating, the first 3 rows are reserved for people on the program. Registered guests with name tags have priority for indoor seating, but I guess that will, until tomorrow, we won't need that. But again, those name tags are negotiable as well, so you can move them around. Anybody who speaks is going to be requested to sign a media release form, and that's necessary in order to put these things up on the web and in a podcast and all these modern things. So let me, without further ado, turn this over to our partner, Stuart Gabriel from UCLA.
Well, ladies and gentlemen, good morning. It's a pleasure to see all of you here. It's a pleasure to be here, certainly at this first of what we hope is many Berkeley UCLA symposia. A number of my colleagues are here from UCLA. I want to say on behalf of UCLA that we're so pleased to partner with our colleagues from UC Berkeley. Certainly grateful to all our friends at Berkeley, grateful to John, to Larry, and to everyone for their extraordinary efforts in bringing this conference to fruition. We're grateful similarly to all the academics and policymakers in the room from Berkeley, UCLA, from around the country. People had very tight deadlines in producing research and commentary for this meeting. Now, as I think we all well appreciate, the meeting comes at a key moment in a very fast-moving and even critically evolving story. We all know of sort of this swirling of contagion effects, as has emanated from housing and housing finance and gone to every asset class, every sector, every geography, even described by some analysts as a pandemic in its reach across this world of ours. Chip Case is here. Chip and his colleague Bob Schiller a couple of days ago released their latest numbers on their S&P Case-Shiller index. Here in California, we've been especially hard hit. According to Chip's numbers here in the Bay Area, in LA and San Diego, house prices are down year over year by an excess of 25%. We know that for the most part, the secondary mortgage markets are closed, this with the exception of our government-backed debt. And clearly, the lack of a securitization market for prime jumbo mortgages is highly problematical for many of our markets. You probably heard this week that the Conference Board released the lowest estimated level of consumer sentiment in the 40-year history of the indicator this week, the largest drop monthly in that indicator. And certainly this is a concern. You saw the new GDP numbers for the third quarter this morning, a contraction in the third quarter, the largest drop in consumer spending in 28 years, something that took 2.2% off of real GDP growth. So, of course, Janet will speak momentarily, but the tea leaves are suggestive, clearly, of a consumer-led recession. And why not, as every pillar of support has been knocked out from under the consumer in the form of housing wealth, financial wealth, labor income, and all the rest. In fact, there's research that was done some years ago at the San Francisco Fed that suggests that in unusual times such as these, the consumer sentiment indicator may be unusually salient in its determination of economic activity, indeed as sentiment becomes aggregated to one end of the distribution. Janet may speak to us about the activities of the Fed over recent days and months, 100 basis points in the month of October, 425 basis points since the beginning of the easing. And yet, as we saw on the chart on the front page of the Wall Street Journal, retail lending rates perhaps across the board not showing much evidence of that easing, although as Janet perhaps will point out, the counterfactual is important as well in the sense that it's difficult to tell stories about what would have been had that easing not occurred. Nonetheless, we're looking to some restoration of liquidity and confidence, as Paulson has suggested to financial institutions receiving government money that they need not hoard that money, but rather get it into the system. I guess what I'm saying is that the conference that we have today is not only of academic interest, it's consistent with broader issues of national policy. And as John indicated, as we put the conference together some 6 months ago, and sort of appreciative of the lead-lag relationship between housing and the rest of the economy, we anticipated that as we got closer to this date, things would not be looking so good with the broader economy. So what you're going to see here and what John described is what I'd call a normative as well as positive approach to these analyses of the crisis. A number of our papers tomorrow are positive in setting a baseline with respect to macroeconomics, urban economics, and geography of foreclosures and the like. And then, of course, we turn in many of our panels, Nancy's panel and many of the other panels, to kind of normative perspectives on policy prescriptions. John has told you about the agenda. I will not repeat that. Both of us feel strongly that we would like to take advantage of expertise in the room, and we're going to try to the extent possible to do that. And now what I'd like to do is introduce Janet Yellen. Now, many of us know Janet as the esteemed president and CEO of the Federal Reserve Bank of San Francisco. But here on the Berkeley campus, she's known as a great colleague and a friend and a professor since 1980 in both the economics department and the business school. And of course, has deepened our understanding of many labor market issues with her research. She's had an extraordinary career of leadership beyond academia, serving as a member of the Board of Governors of the Federal Reserve System, as chairman of the President's Council of Economic Advisors, and of course, course, in many other capacities, certainly today as president of the San Francisco Fed. Her bio is so distinguished in terms of her participation as a member of the Council of Foreign Relations, the American Academy of Arts and Sciences. The list is very deep and very long. Janet holds a PhD from Yale, and she will now tell us more about what's going on out there. So please join me in welcoming Janet Yellen.
Thank you very much, Stu, for that lovely introduction. You've made a very good short summary, forecast and short summary of my remarks, so I'm tempted to stop since you've hit all the high points, but I'll go into some more details. It's a pleasure to be back on the Berkeley campus. I have great affection for this institution, and it's terrific to see so many old friends. The conference that you're holding on the mortgage meltdown, the economy, and public policy just could not be more timely. The mortgage meltdown is far from over. The economy and financial markets are still reeling from it, and policymakers have responded by taking some of the most momentous steps in decades. So today I'd like to consider these developments from my perspective at the Federal Reserve. I know that you will be hearing from Chairman Bernanke later in this conference, and I do want to emphasize that the views that I'll express are my own and not those of my colleagues in the Federal Reserve System. My aim is to help tee up some of the other sessions in the conference by providing a look at the current interactions between mortgage markets, financial markets more generally, financial institutions, and macroeconomic performance. In brief, if anyone ever needed a demonstration of the strength of the links between the functioning of the financial system and the functioning of the economy, this is it. The downturn in housing construction directly weakened economic activity, while the drop in house prices precipitated a genuine crisis in financial markets, which has generated a severe credit crunch. The credit crunch, in turn, has left households and firms with fewer resources to finance spending, and as a result, output growth has weakened further and unemployment has risen. And of course, weak output growth and higher unemployment undermine households and the housing sector, which worsens the credit crunch, which saps spending, and this feedback loop, this adverse feedback loop, just goes on and on. The Fed has responded both by easing the stance of monetary policy, including, as Stu mentioned, the 50 basis point cut earlier this week, and by supporting financial stability through enhancing market liquidity. I believe that these actions have been helpful, but the enormity of this crisis required more. In particular, the passage earlier this month of the Emergency Economic Stabilization Act of 2008 made possible an infusion of capital into the financial sector, and I think that was a crucial step in breaking the momentum of the adverse feedback loop. Another approach to resolving the crisis involves addressing the problems plaguing the housing market directly, through increased aid to distressed homeowners to mitigate foreclosures, or through broad-based incentives to boost the demand for housing. I think such policies deserve consideration because they go to the heart of the problem, namely the fallout from the boom and bust in the housing market, and that's what I'll turn to next. The bust in the housing market has, of course, been hitting the economy for some time now. Although residential investment accounts for only a small share of overall economic activity, its decline over the past 3 years has been a major drag on real GDP growth. During this period, housing starts have plummeted. They're down by over 30% just in the past year. Yet inventories of unsold new and existing homes remain at very high levels, especially relative to sales, and that makes it difficult to predict with any confidence when starts will bottom out. In fact, the possibility of ongoing contraction in this sector is intensified by the interplay of the economic downturn and the credit crunch. Understandably, financial institutions have tightened lending terms, making it more difficult to qualify for a mortgage by requiring higher down payments, higher income-to-payment ratios, and higher FICO scores. Moreover, as Stu mentioned, private label securitized markets for residential mortgages are essentially closed for business. The only remaining sources of mortgage securitization are the government-sponsored enterprises, especially Fannie Mae and Freddie Mac, which provide backing mainly for conventional conforming mortgages. For higher risk borrowers, the Federal Housing Administration, the FHA, is close to the only game in town. Along with the decline in construction, house prices have fallen by around 15 to 20% from their peak, depending on which measure you use. Unfortunately, this is another case where the bottom is not yet in sight. First, the ratio of house prices to rents still remains high by historical standards, suggesting that further price declines are needed to bring housing markets into long-run balance. Second, the large inventories of unsold homes I mentioned, a growing share of them are foreclosures, that also can be expected to continue to put downward pressure on prices. In view of these factors, it's not surprising that futures contracts for house prices developed by Chip Case and Bob Schiller predict further declines, and perhaps they'll have more to say about this later in the conference. The decline in house prices appears to be the crucial falling domino that set off the chain of distress that now plagues financial markets and the economy. Problems first appeared with the growing delinquencies and foreclosures in the subprime mortgage market. Currently, more than 20% of them are seriously delinquent or in foreclosure. And real trouble spots include parts of Nevada, Florida, and Ohio, and of course here in California. Here, some of the highest delinquency rates are in the Central Valley, with Merced and Stockton as leading examples. As many of you know, the Fed has embarked on a number of studies relating to the subprime mortgage market. In fact, two colleagues of mine who are prominently involved, Paul Yellen of the Boston Fed and John Krainer of the San Francisco Fed, are on the program for this conference. The research that they and others have done on the variation in subprime delinquency rates across regions and over time confirms that the riskiness of the borrower pools and the quality of the underwriting standards do help, as you would expect, to explain the incidence of subprime delinquencies. But the single best predictor of the level and change in these delinquency rates is the pace of house price increases or decreases. In fact, the research suggests that differences in house price changes account for much of the regional differences in delinquency rates. And this is true whether borrowers are prime or subprime, or whether loans have fixed or variable rates. it's not hard to see why falling house prices matter so much. The amount of equity in a home affects the ability or willingness of homeowners to keep current on their mortgage payments when they face personal setbacks, such as illness, divorce, or the loss of a job. In a market in which house prices have been declining, a borrower with a recent mortgage secured with little or no down payment doesn't have the flexibility to tap into the equity in the house to weather these problems. Or they may be unable to refinance or sell the house for enough to cover the outstanding mortgage balance. Moreover, in states like California, where a primary residence represents no recourse collateral for many mortgages, some borrowers who may be able to afford their loans may nevertheless be unwilling to make the payments if house prices are expected to remain low or decline. Saying that, though, I would note that historically many homeowners with underwater mortgages have not ended up in foreclosure. An additional factor that intensified the effect of house price declines on subprime delinquencies is that many of those loans were designed to be bridge loans. For example, so-called 228 loans were set up at fairly high initial mortgage rates for borrowers with low FICO scores. If such a borrower made the payments, and if the price of the house rose as expected, the borrower would be able to refinance, presumably at a lower rate in 2 years. However, once it became apparent that house prices were falling, and therefore that the refinancing opportunity was lost, many of these loans went into default even before the initial 2-year period expired. So far, I focused on problems with subprime mortgages, but more recently the problems have spread. The number of serious delinquencies on Alt-A loans and even adjustable rate prime mortgages is now on the rise. In addition, foreclosures on the 2007 vintages of mortgages are rising at about the same rate as those of earlier vintages. And this is sobering because many of the loans in these later vintages, especially those issued in the second half of 2007, those loans benefited from tighter underwriting standards that were put in place once the crisis hit. Most likely then, the rising foreclosures are related not only to falling house prices, but also to the weakened economy, and in particular to the nearly 1.5 percentage point increase in the unemployment rate over the past year. The erosion in credit quality that afflicts not only subprime, but also prime mortgage and home equity loans has also now spread across the full spectrum of consumer loans. This includes credit card, closed-end consumer, and automobile loans. These losses are compounding the pressures on financial institutions and exacerbating the resulting credit crunch. Some people have asked why policymakers and others didn't see all of this coming. Well, a lot of people talked about a bubble in home prices that could eventually collapse and lead to sizable credit losses and significant negative wealth effects. I think the answer, though, is that they did not fully understand how these effects would be magnified by several key features of the financial system, features that have interacted with one another to produce a deep wariness about counterparty risk and a freezing up of credit flows. Each of these features corresponds to one of the 3 main elements of a balance sheet: assets, capital, and liabilities. I'll start with assets. Here, a part of the problem is with the new securities and related derivatives that have been used extensively in this decade in mortgage finance, and in fact throughout the financial system. They were once considered state-of-the-art, dazzlingly complex, capable of spreading risk, and constructed using sophisticated mathematical models to price the risk. But it turns out that their very complexity makes it incredibly difficult now to know where the risk actually resides or how to price it. And that gives rise to major concerns about counterparty risk. Turning to capital, the problem is that there is a shortage. In other words, there's too much leverage among financial institutions as a whole. Capital in many banking organizations has been adversely affected because of write-downs of many of the complex instruments I referred to, and also because of credit losses primarily associated with delinquencies and foreclosures on real estate loans. Moreover, investment banks and other entities in the so-called shadow banking sector were very highly leveraged, with a ratio of assets to capital exceeding 30-to-1 in many cases. Such slim equity cushions increase firms' exposure to insolvency in the face of credit losses or asset write-downs. Finally, on the liability side, the problem is that many leveraged financial institutions relied heavily on very short-term debt, often overnight loans to fund their operations. And this has made them vulnerable to runs, especially in an environment where everyone knows that the system is exposed to impaired assets, where it's hard to determine exactly where those risks reside, and where some firms are known to have only slim equity cushions. As financial firms have struggled to fix their own problems, the systemic consequences have become painfully apparent. Firms have tightened lending standards, trying to improve credit quality, and they've reduced the volume of loans. They've also been selling assets in an effort to deleverage their balance sheets. But the simultaneous attempts of so many firms to deleverage have depressed asset prices to fire sale levels, producing additional losses and thereby creating selling pressure for other firms holding similar positions. Write-downs on such securities are reducing the already diminished equity cushions in some firms and raising their leverage at a time when they desire less leverage and not more. This vicious circle has led to outright illiquidity in markets for certain asset-backed securities, making it almost impossible to determine appropriate prices and largely eliminating them as a source of new funding to borrowers. Moreover, financial institutions and even non-financial firms have become very reluctant to lend to each other, except at the shortest maturities, since they're uncertain about what demands they could face and whether they'll be able to borrow to meet them. As a result, they're hoarding liquidity. These responses have led to a greatly reduced flow of credit in the economy, which is the major factor responsible for the economic downturn that's now underway. In other words, in my view, we are in the grip of an adverse feedback loop in which a credit crunch exacerbates economic weakness, which in turn weakens financial institutions, intensifying the credit crunch. Indeed, recent data on the economy have been deeply worrisome. As Stu mentioned, data released this morning reveal that the economy contracted slightly in the third quarter. For the fourth quarter, it appears likely that the economy is contracting significantly. Mainly for this reason, inflationary risks have diminished greatly. Over the past year or so, the FOMC has cut its federal funds rate target by 425 basis points to its current level of 1%. Nonetheless, again, as Stu mentioned, having hit all of the high points, most private sector borrowing rates are higher now than they were at the beginning of this crisis in August 2007. And in pointing this out, I don't mean to imply that the rates did no good. Borrowing rates, in my view, would be substantially higher than they are now, absent the reduction in our base lending rate. It's just that the effects of the growing credit crunch have outpaced the easing of policy, and indeed, every major sector of the economy has been adversely affected by it. For consumers, the credit crunch is one of several negative factors accounting for the decline in spending in recent months. Consumer credit is costlier and harder to get. Loan rates are up, loan terms are tougher, and increasing numbers of borrowers are being turned away entirely. This explains in part the exceptional weakness we've seen in auto sales. In addition, of course, employment has now declined for 9 months in a row, and personal income in inflation-adjusted terms is virtually unchanged since April. Furthermore, household wealth is substantially lower as house prices have continued to fall and the stock market has declined sharply. Business spending, too, is feeling the crunch in the form of a higher cost of capital and restricted access to credit. In particular, many companies find that the financial markets have become unreceptive to their commercial paper, which is an important source of short-term funding. Some of our business contacts report that bank lines of credit are more difficult to negotiate. Many indicate that they've become cautious in managing liquidity, in committing to capital spending projects when they can be deferred, and even in extending credit to customers and other counterparties. Non-residential construction also is headed lower, largely because of the financial crisis. The market for commercial mortgage-backed securities, a mainstay for financing large projects, has all but dried up. Many state and local governments are being dragged deeper into the financial mess as well. The downturn in the economy has bitten into their tax revenues, and disruptions in financial markets have made it harder for them to issue bonds. Until recently, weakness in domestic final demand was offset by a major boost from exporting goods and services to our trading partners. Unfortunately, economic growth in the rest of the world has also slowed noticeably. There are a number of reasons for this slowdown abroad, including spillovers from the US downturn, and most importantly, the financial meltdown that now has intensified in Europe and elsewhere. In addition, the dollar has appreciated recently against the currencies of many of our trading partners, and that offsets a portion of the depreciation that was boosting US exports. So the result is that exports will not provide as much of an impetus to growth going forward as they did earlier in the year. Well, now that I've reviewed the current economic situation, I'd like to turn to policy, beginning with a discussion of actions taken so far and additional remedies that bear serious consideration. I've already mentioned the FOMC's substantial easing of monetary policy. In addition, the Fed has ramped up its use of an arsenal of liquidity tools, We've devised new facilities to lend directly to banks, primary dealers, money market mutual funds, and non-financial firms that have been frozen out of the credit markets. These facilities reduce the chance of runs on financial institutions by providing the assurance of short-term funding from the Fed based on an expanded range of collateral. Beyond these facilities, the Fed has provided direct financing to prevent the outright bankruptcy of Bear Stearns and AIG, whose failure in the judgment of the Fed and the Treasury would have significantly undermined financial stability. Even though the Fed has done much to attack the financial crisis, more was obviously needed. A comprehensive solution requires actions that are fiscal, in the sense that they use taxpayer funds or place them at risk, and thus extend beyond the Fed's legislative mandate. The actions that have now been announced or implemented fall into three main categories, and they correspond to the three underlying problems in the financial system that I mentioned earlier: impaired assets, capital shortage, and uncertainty about short-term funding. With respect to impaired assets, the Treasury is formulating plans to purchase mortgage-related assets from financial institutions. This could reduce uncertainty about the valuation of these instruments, restore some liquidity in the secondary markets, and would improve capital positions if the actual purchase prices exceed the fire sale levels that now prevail for many asset-backed securities. The second problem afflicting the financial sector, capital shortage, is critical. It's therefore extremely heartening that the governments of all countries involved in the crisis have announced immediate plans to inject capital into their financial systems. With respect to short-term funding, direct government guarantees against default have been extended on an emergency basis to boost public confidence in lending to financial institutions. And these guarantees cover most deposits as well as newly issued senior debt. I believe that these steps are extremely constructive, and I think they will help over time to ease some of the wariness about counterparty risk and help thaw credit flows. So far, we've seen very tentative signs of an easing of stress in money markets. For example, LIBOR OIS and credit default swap spreads are down somewhat. But these spreads remain at levels that are well above normal. And other measures of stress have risen even further. So clearly, we have a long way to go before the credit crunch shows significant healing. And for that reason, I think it's worth considering other types of policies to address the crisis. For example, several programs to mitigate the problem of foreclosures and the credit losses precipitated by falling housing prices are either in effect or have been proposed. They fall into two broad categories: those aimed more or less directly at reducing the number of foreclosures by focusing mainly on helping homeowners who are at risk of losing their homes. And the second category designed to reduce borrowing costs for a much wider population, thereby supporting the overall demand for housing and hence housing prices. In the first category is the Hope Now Alliance, which is a voluntary program that began in October 2007. It brings together counselors, servicers, investors, and other mortgage market participants. It facilitates the reworking of mortgage loans by marshaling the incentives of lenders and borrowers to avoid the the deadweight losses associated with foreclosures. A second example is HOPE for homeowners. That's a federal program resulting from legislation sponsored by U.S. Congressman Frank and Senator Dodd. This program just went into operation at the beginning of this month. It expands the role of the FHA to improve loan workout options by providing a government guarantee of payment to lenders. In return, lenders must forgive a portion of the principal to make the new loan more affordable. In addition, the program includes a shared appreciation feature in which the FHA and the homeowner divide both the equity created at the beginning of the new mortgage loan and any future house price appreciation. Expanded versions of such workout approaches have also been proposed. In particular, FDIC Chairwoman Sheila Bair has suggested guidelines to target and streamline the loan modification process. She also proposes using loan guarantees authorized by the Emergency Economic Stabilization Act as an incentive for servicers to lower mortgage payments so as to make them affordable and sustainable. Other proposals are modeled on the Homeowners Loan Corporation that was instituted in the Great Depression. The basic idea is that the government would offer to buy underwater loans, now estimated to be about 15% of total mortgages, to buy these from lenders and refinance a new mortgage for qualifying homeowners at a lower rate. Programs like these are targeted at borrowers who are already or are likely to end up in foreclosure. They have the potential to keep qualifying homeowners in their homes with sustainable mortgages, thus avoiding the deadweight losses and negative community spillovers of foreclosure. By mitigating foreclosure sales at fire sale prices, these programs may also support housing prices more generally and serve to limit the credit losses that have done so much to damage the financial system. The broader the debt relief that a plan provides to households, the more it is apt to spur consumer spending and reduce credit losses. But the cost to taxpayers is likely to increase as well. Speed of implementation is another key consideration, and loan modification plans that involve dealing with and analyzing the individual situations of large numbers of borrowers tend to be quite time-consuming. A second category of proposals is aimed at a much broader set of borrowers and would boost the overall demand for housing by reducing borrowing costs through low-cost government loans or tax credits. They hold the potential to reduce the number of foreclosures and associated credit losses both directly by reducing after-tax house payments and indirectly by providing support to house prices. It's true that house prices do need to adjust, and until they do so, potential buyers may stay out of the market. However, the concern is that house prices may overcorrect for a number of reasons, not the least of which could be today's extraordinarily tight credit conditions. This overcorrection could have devastating effects on the financial system and the economy, and such programs seek to avoid that outcome. My objective in discussing these ideas is not to support one particular plan or the other. Rather, I want to emphasize that such programs, which provide direct assistance to homeowners in the housing market, are worthy of serious consideration as additional steps beyond the policies that have recently been adopted to address stress in financial markets. Needless to say, the pros and cons of each that I've described give just a glimpse of how difficult it's going to be to design approaches that are both effective and timely. Moreover, there is no doubt that beyond these short-term strategies designed to quell the crisis, long-term and more fundamental reforms are needed as well. This conference, which has brought together so many experts on these subjects, is the perfect forum for discussing such important issues. So let me stop there, and I would be happy to take some questions.
So who'll have the first question? Janet, do you want to?
Bob.
I was fascinated that you got the policy, you were thinking only of attacking the house price problem sort of directly rather than dealing with more locally, which I would have thought that you would have come out, as you have in the past, for some kind of a tax cut or temporary tax cut or other broad-based stimulus to the economy. In particular, it seems to me that the programs that you're talking about fail an elementary test of horizontal equity. How do you explain to people in Redwood City that they don't get the same benefits that somebody in Merced does just because they happen to live in a different community, as opposed to a broad-based stimulus?
Yeah, I didn't mention fairness and equity considerations in my list of issues connected with all of the housing proposals, but I believe those are obviously there, and in the case of some proposals, quite worrisome and tricky to deal with, maybe impossible. I think certainly, I mean, Chairman Bernanke testified, I believe it was last week, before Congress, and indicated that in his opinion it was appropriate for broader fiscal measures to be on the table. And I'd say, given the data and my concerns about where the overall economic picture is going, and the fact the Fed has already done a great deal, much of what it can do to address this crisis, that it certainly makes sense for Congress to be considering broader fiscal measures. I think it's up to Congress to decide what to do. The usual set of things people mentions are targeted, timely, and temporary. Chairman Bernanke actually went slightly beyond that in his testimony and suggested the possibility that Congress might want to think about targeting fiscal relief, if it goes in that direction, on measures that would address the credit crisis and its impacts more directly. And I thought that was an interesting potential approach. But I think certainly at this point it's appropriate for broader fiscal measures to be something that Congress should be thinking about.
I'm a little confused. If you say the cause has been the housing bubble and of prices, and so many of the solutions seem to be to want to recreate housing prices, I don't know, back to the bubble level or not, or people got into home ownership with liar loans, with all sorts of things, and now you want to try to, rather than finding where the market really is cleared, you want to artificially up the price of homes. Or so it seemed with some of the suggestions.
I did say explicitly in my remarks that house prices do need to correct. And I think that they need to do so for buyers to be willing to come back into the market. I think part of the shortage of demand, one factor, is the concern that house prices continue to fall until they have reached some level consistent with fundamentals that impedes recovery in the housing market. So I certainly am not arguing in favor of recreating bubble conditions. That's not a policy I think would be wise. But I think we are, especially given the tightness of credit conditions and the very limited availability of credit in the mortgage market now, and the broader deterioration we've seen in the macroeconomy, I think we are in danger of an overcorrection in the housing market. And I think that would deepen this adverse feedback loop that I've talked about and take a greater toll on the economy. And so I did try to be careful to state that my concern would be with an overcorrection of house prices, which I think is feasible, is possible, and I do think that house prices need to correct.
Pleasure to see you. The Fed has done a lot of things right, and so has the Treasury. But one thing that's surprising about the Treasury is they're giving a lot of money to banks and permitting the banks to give that money to their shareholders as dividends, which we saw a lot of in Japan with a large flow from taxpayers to shareholders. Given the importance of building up assets at capital at the bank so that reduce counterparty risk, wouldn't it make more sense to have a little dividend holiday and the bank values would go up because the counterparty risk would go down?
This is, thank you, David. This is a Treasury program, not a Fed program, and I was not involved in designing this. There are some restrictions on dividends. It is not permissible without the explicit authorization of the Treasury to raise dividends. And remember that the capital that's being injected in this program is not designed for failing banks. I think in Japan, if I'm not mistaken, you often had banks that were obviously undercapitalized that were continuing to pay out dividends and deplete bank capital. This program, the TARP program of capital injections, is designed for and restricted to healthy, viable banks to enhance their capital. But there are dividend restrictions. I agree that they could have been yet stricter, but
Janet, I wanted to come back to the overcorrection problem that you mentioned. And one possibility would be to find a new market of buyers to expand the demand for housing. Now, I'm not thinking of people buying whole houses. I'm thinking of re-looking at the housing problem and let housing be more divisible, like corporate equity, for instance, so that this mismatch right now where individuals have much too much of their assets in one home and all institutional investors have nothing. So there's a big opportunity here for gains in trade if the homes could be made divisible, and then institutional investors, whether they be in the US or around the world, could come in and buy 5% of 1 million houses, rather than trying to find 1 million new buyers.
Right. I gather that you have a plan along those lines, and I think those are indeed very interesting ideas. I think the legislation that was passed for Hope for Homeowners does have something a little bit in that spirit, in that it has a shared appreciation feature, so that in effect the government is becoming a partial equity owner of the house. There are a number of other plans that have been put forth. There's been kind of a proliferation of plans, and I haven't even tried to list all of them. But the notion of a partial equity sellout and shared appreciation, I think, is an interesting and potentially attractive feature of a plan of this type. I think it's something that could make sense. I mean, it's the kind of thing that I hope you will discuss and debate. I think we need to think these through and compare plans more systematically.
I was wondering, what sort of implications do you see for the broader economy if the Fed were to entertain an even lower target rate, potentially even a 0% interest rate?
Well, what implications for the economy? We would do it because we are concerned about weakness in the economy. It would be a response to weakness in the economy. And we've now gone to 1%. I think potentially we could go a little bit lower than that. What the effective number is that would correspond to 0 in the United States, I'm not exactly certain. As you go ever and ever lower, there are a number of institutional features. I wouldn't call them broad economic considerations, but institutional issues to consider. As the rate goes ever closer to 0, there are implications for the functioning of money markets, institutional money markets, and the Fed funds market that might constrain exactly how low they might go. But the reason to lower rates and to lower them promptly and aggressively, as I think the Fed has done, is to get ahead of the curve and to try to support the economy against the kind of weakness that Japan experienced for over a decade. I think people who've looked at what Japan did realize, yes, eventually they went to 0, but they should have aggressively cut monetary policy toward 0 more rapidly than they did in order to keep the economy away from deflation and extreme weakness from developing. So I see it as a response to the weakness in the economy. Now, one of the things that Japan did after its interest rate fell effectively to 0 was to engage in open market operations to buy up a range of assets and essentially pay for them by creating reserves, in spite of the fact that it no longer had any impact on interest rates. And that was, in other words, it expanded its balance sheet, and the policy name given to that was quantitative easing. And there is a debate as to whether or not quantitative easing, essentially open market operations or Bank of Japan balance sheet expansion that occurred, whether it did or did not have any significant economic impact. Now, you might think about the United States and say, well, if we were to go to 0, that would give the Fed then the ability to engage in a kind of quantitative easing to increase the scale of our banking, of our balance sheet, of the Fed's balance sheet, to give more credit, buy up more assets, or more generally extend more credit to try to help improve the functioning of financial markets. Now, in effect, I would say we have already, even without going to 0, are in effect doing that type of policy. The size of our balance sheet has gone about a year ago. The total assets held by the Federal Reserve consisted almost entirely of Treasury securities held outright, and it amounted to around $800 billion. And over the last year, the overall size of our asset holdings has roughly doubled. And by the end of this year, if all our facilities become fully used that we have announced, we could go to close to $3 trillion. And you might think of this as a kind of quantitative easing. One of the things that was included in the Emergency Stabilization Act that was passed by Congress was it gave the Fed the authority to pay interest on reserves. And this was sort of a little noted feature of the act, but we put it into effect immediately. It's currently in effect. And at this point, we're paying interest on reserves at 35 basis points under our target Fed funds rate. In effect, that enables us to come pretty close to setting a floor on the federal funds rate, which might be different than 0 and higher than 0, and then to extend greater liquidity, to increase the size of our balance sheet, And we have done so in a massive way already without going to a zero interest rate. So we don't need to go to zero to do it. And we've done it in order to try to create credit facilities to unthaw frozen credit markets and provide credit.
This is a follow-up on the dividend question and I guess the shared appreciation question, though I didn't think of it in shared appreciation terms. My understanding is the contrast between the UK program of capital injection and the US program is that in the UK, the government is effectively able to buy, or is announcing that it will buy common shares in banks, whereas it's preferred shares in the US. And it seems to me from the standpoint of both dividend policy, not having the control that common shares implies makes for a material difference. And from the standpoint of upside for the taxpayer, again, common shares would be preferable to preferred shares. Do you have any commentary on why the contrast between the two policies? And I know, again, it's Treasury, not Fed policy, but.
Yeah, I mean, again, you know, again, this is a policy of the Treasury, and I think it reflected a desire to leave this be a voluntary program for healthy, not for failing institutions. So these are healthy institutions that are receiving these capital injections, and it is a voluntary program, and there is a desire, in part, by being willing to accept a capital injection. One might argue that institutions, by making themselves safer, are creating an externality by making the entire system safer. So there was certainly a desire to want banks and financial institutions to be willing to participate and not to make the terms so onerous. So it's a balancing between cost and advantages to the taxpayer and a voluntary program that financial institutions should regard as desirable to participate in. I think that's the balance the Treasury was concerned with. There is upside for the taxpayer, though, because in addition to preferred shares, there are also warrants that the financial institutions have to sell to the government, and that does create upside risk for the taxpayer that would be akin to common stock. But there is not the control that would go with being, with nationalizing banks or something of the sort.
We have time for about 2 more questions. Chip?
I think so. Janet, thank you very much for your excellent comments and discussion. Small businesses are particularly hard hit by the credit crunch. Do you have a view of whether it makes sense to greatly expand and subsidize loans for small businesses through, say, a greatly expanded small business loan program? Maybe that's outside of it's more fiscal than the monetary authority of the Fed, but do you have a view about that?
Rich, you mean a direct program of the Fed akin to what we've done, or you're thinking of a fiscal, a congressional, or a Treasury program?
I'm thinking of either, really, but a direct assistance to small business lending, whether it comes through the fiscal side or from the Fed side.
I mean, let me speak to the Fed side, which I guess I know better than the fiscal side, which sort of takes me outside of what's in the direct area of my expertise. You know, there are limitations as to what the Fed can do. The Federal Reserve Act restricts the lending we can do. It's clearly the Federal Reserve Act envisioned our being a source of backstop liquidity to banks, and the notion being by supporting the banking system, making liquidity available, and now this broader program of capital injections, that would be the means for improving credit conditions in the broader economy, including smaller businesses. Okay, to go beyond lending to depository institutions requires invoking really rarely used, not since the Great Depression, authorities contained within the Federal Reserve Act. And we have used those authorities. A supermajority of the board has had to declare unusual and exigent circumstances. And then there needs to be a further determination in some sense that an entity finds it almost impossible to have their credit needs satisfied in the financial markets more generally. So the hurdles that need to be satisfied for the Fed to engage in lending, a direct lending, and our loans have to be secured and collateralized. And this begins to pose greater and greater hurdles to what we can do. And my guess is that in thinking about a potential facility for small businesses, it becomes very difficult for the Fed to meet hurdles of that type. They be securitized and there not be credit available. So my sense is that, well, I completely agree there is a credit crunch, and firms and households are finding it quite difficult, increasingly difficult to gain access to credit. I think it would be too extreme to say the small business loans are just not available. I mean, my sense is that they continue to be made. Jumbo mortgages. Are jumbo mortgages available? Yes, but they're expensive and it's hard to qualify. So I think we ourselves would find that a very high hurdle to reach. My hope is that by improving financial conditions more generally, that banks would be in a situation where they would find it desirable and profitable to meet the needs of smaller business. If that doesn't occur, certainly it's something that Congress could consider, maybe as part of a fiscal package, acting directly there.
One last question.
One last one, I'll drag it back to house prices. The worst possible outcome in the case of a delinquency is a foreclosure. And so these proposals, there are about 5 of them we're going to talk about in the next couple of days, to restructure quickly, it seems to me, are the way to go. But they have a particular problem, and that is getting the restructuring imposed on the people who hold the paper, who have contracts. And it's difficult for a number of reasons. Part of it is that this decline in house price is very uneven, right? It's in Florida in spades, and it's in Arizona. 86% of the properties traded in Arizona are foreclosure sales, and so it's in pockets, even within metropolitan areas. If you look at Boston, where I'm from, there are places that haven't depreciated at all, and there are other places that are down 40, 50, 60%. And it's those ones that are falling most rapidly that are creating the problem and are going to be the most difficult. So the real question is, are there ideas out there to give power to the people who are going to restructure these things?
Well, you know, I think some of the ideas that Chairwoman Bear has put on the table are really intended to make this happen more easily and more automatically. I do want to say this is not an area in which I'm an expert at all, so I want to say that up front. But
yeah, but you're good.
Well, thank you. My understanding is when the FDIC took over IndyMac and, of course, is operating it, that they made a commitment to try to restructure mortgages to keep people in their homes if it was possible, and have come to the view that, if I'm not mistaken, that a way to do that is to make the mortgage payment more affordable, that if the payment is affordable, that people are more likely to be willing to stay, and that this is true even if it happens that the house may be underwater. So a possible approach that might be easier for servicers, and I believe that the FDIC in their role at IndyMac is in the position of servicer of many mortgages that are not owned by IndyMac, but they're servicers of them. That by making agreements to lower the monthly payment, the interest, by making it a change in the interest payment on the mortgage rather than writing down the principal, that does not violate or is not thought to violate the agreement that they have as a servicer. In the same way, it doesn't create the same complications with respect to the servicing agreement that occur when the servicer is writing down principal. And so I think maybe modifications that Chairwoman Bear has proposed along those lines of don't focus so much on writing down the principal, but direct the support and the negotiation more toward the interest, if it can be made affordable, could result in a faster process, a streamlined process, and one that would be a lot less problematic from the view of servicers. There could also be guarantees provided through the TARP as well for agreements like that. So I think thoughts like that are kicking around.
Well, you are good.
Thank you.
On behalf of all of us here, I want to thank you, Janet, for making 4 trips over the bridge today rather than 2, and for your willingness to engage the audience in an extensive and frank discussion of these alternatives.
It is my pleasure to welcome the next panel, and both John and Stuart, and certainly Janet's remarks, gave a really wonderful introduction for where we're going, because this panel has been charged with looking toward the future. And even in all the chaos that exists right now, and thinking about avenues out of this. And we have quite a wonderful panel in terms of addressing various visions of how this future could evolve. From both commercial banking, from regulatory research at the San Francisco Fed, and also from the capital market perspective, and also from the counseling and low-income housing and initiatives that have to do with responsible lending and broadening capital market access for mortgages. So it is my pleasure to introduce my panelists. I have Brad Blackwell, who's the Executive Vice President and Retail Sales Manager, National Retail Sales Manager for Wells Fargo Home Mortgage Corporation. I have Paul Jablansky, who's here with us. He's the principal at 400 Capital Management and was also an advisor to Christopher Dodd and Barney Frank's commissions that led to the creation of Hope for Homeowners, and did a lot of the intellectual hard work in designing and thinking about these contracts. John Krainer is a senior economist at the Federal Reserve Board of San Francisco, and Janet already gave a very nice introduction to as one of our 2 brain trust people here from the Feds. Paul Yellen is in the audience somewhere also. And lastly, Paul Leonard, who's the West Coast Director of the Center for Responsible Lending, who has had a long-term view of this, both the sector that was the initial canary in the coal mine problem of how do you provide mortgage credit for low-income people or distressed areas and actually have these mortgages be sustainable. So I'm going to give each of my panelists about 10 minutes, 10 to 12 minutes to talk about their distinct views of this market, and then we'll open it up, since we do have such an amazing audience here, to questions. So we will start with Brad, and he will talk to us about what is happening right now on private sector commercial lending. Brad.
Thank you very much, Nancy. I think it's good to have a panel and a forum like this to discuss what's going to happen with the future of mortgage lending. I think everybody's heads right now are very much into the present. How are we going to solve the problems that we face today in mortgage lending. But I think it's also important that as we look forward, we're going to have to keep our heads into what does the future look like after the current crisis passes? And the reason that context is important is because if we don't think about and contemplate those issues, some of the solutions we craft today may in fact have a long-term implication for cutting off the availability of credit and home ownership for people in the future. And for those of you that are students sitting in the back, I think that's probably an issue that you will find particularly important to deal with. I want to start with three somewhat context-setting issues. The first is that homeownership is a fundamental foundation of America. It's something that people strive for. It's something that people raise their children. They own homes. They feel ownership of a part of the United States soil is something that's important. And when you have home ownership, you have homes that are better taken care of, neighborhoods that are better taken care of, better education systems, lower crime. It is a good thing. And that's why I say we need to make sure that we retain access to home ownership not only today but for the long term. And I speak to home ownership differently than the speculative real estate investment activity that has largely occurred and run up home prices in the last 5 years. The second is a lesson that I got when I made my very first mortgage loan in 1983. And again, for some of you, that'll seem like yesterday, and others, you will only read about that in a history book. But I received a lesson from my manager the first day I showed up as a mortgage originator, and he told me that when you make a loan, there are 4 things that you need to consider. One is that borrower's ability to repay. Do they have the means to repay their mortgage? The second is the borrower's willingness to repay. Do they want to repay you? You give them the money, they have the ability to repay, but do they want to repay? And of course, my first question was, do I do a psychological analysis on this person? And the answer was really no. You have to look at their history of repayment and their track record of doing these types of things in the past. And you can very much get a predictive indicator of their willingness to repay. The third is the borrower's commitment to the transaction. As a mortgage lender, we are providing you with funds to help buy this property. What is the borrower's commitment to the transaction? And usually that is reflected in terms of down payment or equity in the property itself. And the last one is, what is the quality of the collateral? Because if the collateral is of high quality, the borrower's commitment to stay with it, 1, is good, and 2, the borrower's ability to get out of that property and sell it, should they have to, is increased. Now, I just made all of you underwriters, and possibly better underwriters than we've seen in the last 4 to 5 years in the mortgage lending industry, because if you look at what has happened, we had stated income subprime mortgages at 100% financing. So let's look at what I just discussed. The ability to repay. Stated income means I just trust what you tell me. Do I understand anything about a borrower's ability to repay that mortgage? Second, willingness to repay. Subprime credit by definition says that people likely have not had success in repaying debts in the past. Third, commitment to the transaction. 100% financing does not imply a tremendous amount of commitment. And many of the models that were developed by very, very bright analysts suggested that by collateral alone, we could make high-quality loans. Consequently, 100% stated income subprime mortgages. Now, the rest of the story is history, and we all understand that that is not the case. But as we move forward in the mortgage lending world, we will have to pay attention to the fact that all 4 of those factors will need to be present for a lender to make a good loan. And one of the reasons for the tightening of credit today is that lenders are being forced to put these loans on their balance sheet and are looking at credit underwriting in a more traditional fashion that happened when I started lending in 1983. The third piece of context I'd like to give you is the role of the mortgage lender. Wells Fargo is a traditional mortgage banker. Most of what we lend is not put on our balance sheet. We originate the loan and we sell it into the secondary market. And the role of the lender is such that lenders have a responsibility for two parties. One is the responsibility to the borrower. Is the loan product the lender is putting that borrower in a loan that they can handle, that they understand, and that is sustainable for them so that they can remain in the home, not simply acquire the home. The second responsibility of a lender, as they sit in the middle of the funds transfer, is to the investor. And the role of the lender with the investor is to certify that we have a high-quality transaction and a borrower that will in fact repay this mortgage. That's the role the lender plays, and many lenders over the past several years forgot this role, largely because they were paid by volume, and so drove tremendous amounts of profit with very, very little risk. I could originate a lot of loans. The investors were taking the risk, and by the way, an investor that delegates the risk determination is probably not a very smart investor, and that's another piece that needs to be considered in the future. And the second is that the lender needs to make sure the borrower can stay in the home. This is one of the reasons that Wells Fargo in 2004 generated what we call our responsible lending principles that said that for example, for subprime borrowers, we needed to understand the borrower's ability to repay, and consequently didn't participate in stated income subprime lending because we didn't understand the ability to repay. Now, I'll tell you something, not many lenders followed Wells Fargo. We expected to release these with lots of fanfare, and everybody else would say, that's a great idea, and we'll follow you. But the problem was that there was billions of dollars in profit that were being generated as a result. And our responsible lending principles, I think, fell on deaf ears. It did cost us a substantial amount of market share. But in the end, it's one of the reasons why today Wells Fargo retains its position as the only AAA-rated bank in America and is on solid financial footing. Just wanted to make that point. Responsible lending principles. Never forget. Responsible lending principles need to include ability to repay, informed choices for the borrower, and negative amortization loans, while very successful for the thrift industry in the 80s and 90s, were abused and consequently today are no longer in existence. So lastly, I want to talk about the framework that I think the future should adopt. That is the framework of the need to inspire home buyers to buy property, to share in the American dream. Second, to educate them. And third is to enable them through a healthy financial market. In the enable category, we've got to have affordable capital, and that affordable capital means that we need a vibrant secondary market. Today, the affordable lending role is being taken on by FHA. It's accommodating 30% of the mortgage market today, and virtually all of the low down payment lending is is going to FHA. Fannie Mae and Freddie Mac's role has changed. Their role today is to provide liquidity to the market. And as you think about going forward with this, it would be wise not to put FHA and Fannie Mae and Freddie Mac in competition with one another to see who can do the best job of satisfying the affordable lending role for the government. All that will do is drive bad decisions. The government, as long as they are going to act as the affordable lending vehicle, needs to create policy using a single entity, and that probably should be FHA. Fannie Mae and Freddie Mac, on the other hand, are not fully fulfilling their need today to provide liquidity for the market, and it's going to be important going forward that we find a long-term sustainable role that's likely partially governmental, partially private, that supports the availability of liquidity for the purpose of guaranteeing the risk on these loans. Next is that loan mortgages need to be simplified. Innovation in the past has taken the form simply of an excuse to take on more risk. But innovation in the future needs to be addressed in a way to simplify the mortgage process so that consumers will understand what it is that they're getting. I can tell you that a monthly adjustable negatively amortizing loan is not something that most consumers understand, and I don't think that's an appropriate form of innovation. Innovation could take place in the form of, right now it's very expensive for us to originate mortgages. We are getting more paper to justify lending to borrowers today because of both fraud and the risk that risk mitigation that's being required to do these loans, that innovation could take the form of an ability to electronically and automatically verify a borrower's income and assets at point of sale to lower the cost of origination, streamline the process, and simplify it for the borrower. The questions I think we need to ask as we develop both regulation, and we would recommend strongly that regulation be by a single entity with a single set of guidelines for the entire mortgage industry. This patchwork that we had in the past several years is partially what caused the issues of today, and we truly need a single regulatory body that ensures that we have consistent quality in the way that we originate mortgages. And Fannie Mae and Freddie Mac, or whoever is providing the liquidity, needs to reward quality originators for their excellent origination history, as well as punish those that are performing poorly. Secondly, our next, educate. We do need to educate borrowers. We need to do it in the school system. Right now, financial literacy is not a part of most educational curricula. That's a shame. It needs to be. It is important that we teach them about home ownership right before they get a loan, particularly first-time home buyers. But to some degree, that's like teaching calculus to someone that hasn't learned their multiplication tables. And it is very important, we think, from a policy perspective, that we put financial literacy into the educational system in America. And lastly, inspire. We're in a crisis of confidence. You heard Janet Yellen talk about that earlier. We have all kinds of technical issues that are causing these problems, but we also have an issue of confidence. And as we fix the financial mechanisms, we are also going to have to go hard at the American consuming public to get them back to having confidence in the ability to buy a home. I can tell you that I believe when October results are released a few months from now, you're going to find that some of the recovery that we've seen and that we may hear some of the analysts discuss over the previous months in home sales will largely be eroded because with the diving of the stock market and the volatility of the markets in general that are actually hitting people's pocketbooks are causing them to back away from home buying, and we may see another drop in home sales for the month of October. So it will be important for us to embark both from a public sector and a private sector on a goal of inspiring homeowners to get or consumers to get back to home buying and becoming homeowners. And with that, I'll turn it to our next speaker.
In some respect, I think that the first part of Brad's comments were the principal before picture of the underwriting market. And my comments will be a little bit more of the forensic and prescriptive side of the market, looking at the universe of loans that's outstanding and some of the efforts that were made to stem foreclosures. Specifically, I'd like to take a little bit of a deeper look at the Hope for Homeowners program that was signed into legislation on July 30th by the President and went into effect, I think as Janet Yellen mentioned, the beginning of this month. My role, I was privileged to be able to provide technical assistance to the House Financial Services Committee and the Senate Banking Committee and the Congressional Budget Office. And I think it's possible to argue whether the Hope for Homeowners program is an ideal solution or even a solution that will work. But at least by going through the logic of the program, we can understand a little bit better some of the really amazing technical challenges aside from the political issues, just to get something done. So in the next few minutes, I want to quickly walk through what the objective of the program was, provide some context in terms of the size of the mortgage market and particularly the size of the residential real estate problem, move into some of the details of the program in terms of eligibility requirements, some of the legal and accounting issues that had to be addressed, and in fact will be addressed in any other program that's implemented, and some of the unintended consequences that we need to be aware of. Finally, I'll talk about the logic of the program itself and some of the projections that we made. There are really two objectives. One is very narrow, and that was to provide servicers with one more alternative to foreclosure. The objective was to keep people in their homes, and servicers really have a limited number of tools that are available to them. The broader objective, though, was to potentially spend money, taxpayer money today, to avoid a much larger cost sometime in the future. So let's just talk about the size of the problem for a second. The mortgage market, the residential mortgage market, is approximately a $10.5 billion market. Of that, roughly $2.6 trillion of that is the non-agency securitized market, and there's probably another $1 trillion of non-agency mortgages on bank balance sheets. That leaves approximately $7 trillion of agency mortgages. As we worked through the numbers, and we did most of this work in February and March, our estimate was that in the subprime market alone, we'd see $400 billion of losses, and that was potentially over the next 5 years, with potentially 43% of the entire universe going to foreclosure. If you add on to that, even a relatively modest estimate of, let's say, 2 to 5% of the rest of the mortgage market going to foreclosure, that's another 200 to 500 billion dollars, and those are just mind-boggling numbers. Everyone agreed in the process that certain people would not be able to be helped. People who had stated income loans, for example, and never had any capacity to make their payments. But there had to be some sort of process to qualify people and create an eligible population. And I think that started with owner-occupied homes. No one was trying to provide assistance to speculators in the market who bought second homes or investor properties. We would need borrower and lender certification. Most people roll their eyes at that particular eligibility requirement because these are the same borrowers that in a lot of instances may have been less than truthful on their original mortgage applications. But providing lender certification on the new loan actually probably does have some power. And there had to be some sort of limit on both the size of the new loan and the format. What was the maximum loan to value that would be written? And as the legislation evolved, that number converged on 90%. A very basic principle in this program was to lower the principal balance of the loans, and Janet Yellen spoke a little bit about that as well. I'm going to spend 1 minute on that in a second, but the basic idea behind lowering the principal balances is not so much paternalistic to help the borrower, but rather to help the taxpayer, because lower LTVs, loans with lower LTVs generate lower loss rates, which will generate a lower tax burden for the taxpayers. Now, in addition to that, there were, as I said, legal and accounting concerns. Many of the loans are housed in securitization trusts, and it's very difficult to liberate a loan from those trusts. This is where a lot of the issues with respect to concerns by servicers come up. I think many of the original ideas revolved around buying loans out of these trusts. The HOLC and other similar proposals require some sort of purchase. The problem is you can't purchase loans. You can't purchase performing loans in general out of a securitization trust, and you can only purchase a delinquent loan out at the full amount of the loan plus unpaid interest plus accrued interest. And there's no chance that the loans we're talking about were ever worth anywhere near that amount. The solution which a number of parties came up with independently was to provide a short payoff mechanism. Short payoff is simply a servicer saying, I believe that in a foreclosure, the loan will have a certain recovery. If you, the borrower, can pay me something above that recovery amount, I will take that and extinguish your obligation on the remainder of the loan. That is the basic mechanic behind Hope for Homeowners. We can find third-party FHA-approved lenders that will write a new loan subject to the eligibility requirements. The borrower will take the proceeds of that loan and then pay off the loan in the securitization trust and extinguish any further liability. The natural question I would be asking, listening to the logic that I'm walking through is, well, that's great, and you're actually encouraging the entire universe of borrowers to stop paying their mortgages because you're going to lower their principal balances. This was clearly an issue. What are the adverse consequences or unintended consequences? We could spend a lot of time on this, but what I would suggest is that it's possible to value the option that you're giving the borrower. If the value of the option is essentially the principal balance reduction plus any improvement in payment, plus the intangible of staying in the house, we needed to find something that counterbalanced that. If somebody chose to default on purpose, the only really negative mitigant to that would be a lowering of their FICO score. And I don't think that any borrower would choose not to default and have a loan reduction because their FICO score was going to be dropped. We can talk more either now or later about the mechanics, but basically if you have a $200,000 property, $220,000 loan on that property, and you're going to rewrite that loan to $180,000, you've essentially gifted the borrower with $40,000. You can add over a 5 to 10 year period another, let's call it $10,000 to $20,000 worth of present value today in the reduction of their monthly payment. So we needed to find something that would be worth roughly $60,000, $50,000 to $60,000. If you look at the solution, it was to have shared appreciation in the property. It's complicated. I don't have time to go through the mechanics, but the program retains for the government 50% of any shared appreciation. If that $200,000 property in the next 5 to 10 years appreciated to, say, $300,000, which over a 10-year period is not an unreasonable possibility, 50% of that would be $50,000, and that approximately equals the benefit of the option. Actually, an even larger problem was dealing with existing junior liens, second mortgages. In most cases, the loans that we're talking about going to foreclosure had very high LTVs, usually, and I shouldn't have said it in the past tense, in the present tense, usually above 100, which means that the second mortgages have relatively little value. However, there's another free option for mortgage holders to keep that lien outstanding because if prices rise in the future, that's worth real money to them. No one ever solved the mechanics of extinguishing the second lien. The legislation itself says, all right, guys, you got to work it out yourselves. If you want to get this loan refinanced, it's up to you. Secretary of Housing and Urban Development and the FHA can help facilitate an agreement among lenders, but they never actually proposed anything tangible. And that alone may be the single issue that makes this program very difficult in practice to execute. Just a very quick comment to go back to what I said before about lowering principal balances. The reason we focused on that, again, was to protect the taxpayer. The two alternatives generally in the market are lowering the monthly payment or lowering the principal balance or some combination. Our work analyzing millions of subprime loans, for example, suggests that even a modest reduction in LTV from 100 to 90% has almost the same power in reducing the probability of loss as reducing the debt-to-income ratio, mortgage debt-to-income ratio of a borrower from, say, 60% to 25%. That's an enormous change in the monthly payment. And so I think that many of the loan modification proposals turn into loss deferral techniques as opposed to loss mitigation techniques. The last thing I want to do is just give you demographically some idea of what the loans were like. And again, later, happy to go through in more detail for anyone who's interested. When we worked through the eligibility requirements, we determined that 46% of the eligible population was likely to go to foreclosure. Caveat is, when I say we determined, we used a quantitative model predicting delinquency, default, foreclosure, prepayment, and loss severity on the loans. Happy to have a conversation again later also on whether historical experience is out of experience or not, but that's what a lot of this analysis is based on. We found that there were 1.4 million eligible loans in that universe with outstanding balances of $285 billion. The average FICO score for that population was 637, and our expected loss severity was 54%, generating an expected 154 billion of losses. When you work through the foreclosure economics and the prescriptive remedies in the program, first of all, we estimated that on average, the first mortgages outstanding had an LTV, a current LTV of about 109%. And we felt that, we expected that 87% of the loans in foreclosure would actually go through foreclosure. Some small percentage of loans self-cure. That left about 1.3 million borrowers, 225 billion of outstanding. This is the pool that the FHA would guarantee and that would eventually be sold into Ginnie Mae trusts. The optics here are actually terrible because all of these are loans going into foreclosure. They've all had a drift in FICO downward, and their FICO scores were probably in the mid-500s. The refinanced pool, the new 225 billion, we expected to, on its own, generate 37% default rate with 11% cum loss. And the program had to be designed to pay so that taxpayers wouldn't be on the hook to pay for that 11% loss. That's done through a premium up front. The legislation calls for a 3% upfront premium and then 150 basis points each year. In our own projections, we thought that in an expected case, this would cost the government 2.5% of the outstanding balance of the universe. That was about $7 billion. Congressional Budget Office came up with an estimate of 1%, but on a much smaller loan balance. I've gone over my time, so I'm going to say thank you and
I too have slides. Sorry, John. In fact, I have some slides. In my slides, I have some data and maps provided to me by the crack analyst at the San Francisco Federal Reserve. So maybe I'll get to scoop John on this. Who knows? I haven't seen his presentation. Well, thank you. It's an honor to be here before such an esteemed crowd. And I have probably too much to cover in too little time, so I'm going to try to talk fast and try to hit my main points quickly. We'll certainly make the presentation available through electronic form later. let me just say one thing before I start. The Center for Responsible Lending is a policy and research organization. In December of 2006, we put out a report called Losing Ground that projected that there would be 2.2 million subprime foreclosures over a significant period of time, the life of the loans. That equated to about 1 out of 5. And at the time that we did that, uniformly and particularly with great energy from the Mortgage Bankers Association, they basically belittled our report and suggested that we were in fact being chicken littles about the current state of the subprime universe. I have not heard my colleague Paul Jablansky's numbers here before, but to hear that we underestimated by half the potential foreclosure severity in that report in December 2006 is really kind of a stunning state of just how bad certainly the subprime portfolios and the reckless subprime lending that has played a critical role to getting us to where we are. All right, that said, 3 main points today. You know, I tried to focus this assuming we would have a Berkeley crowd, particularly on California. But clearly the situation has continued to rise at record levels and will get worse for some time. Our critical solution to this is around broader scale loan modifications, keeping people in their homes at an affordable rate it's the economic answer, and for a variety of reasons we haven't been able to do that yet. The voluntary efforts to date have been severely lacking. And then finally, a quick assessment of some of the recent action at the federal level. First, a sort of a stating of where we are, and I'm surprised to have gotten through this part of the panel without actually having, of the conference so far, without having a chance to look at any real numbers. But so we have here some pictures of the growing levels of defaults and foreclosures here in California, starting back from historically low levels all the way up through the third quarter of 2006, and then really taking off without any break until the most recent quarter for defaults, which is really a sort of artificial, and we don't know how effective it will be, change as a result of state law, which delays the start of the default process to allow and requires servicers to contact borrowers and offer to work with them and give them a 30-day period to respond. That's why you see a decline in the third quarter of 2008. I am assured that, in fact, because we see this decline, that the servicers are actually doing this and delaying their defaults. We don't know how effective it will be in leading to more modifications and avoiding foreclosures, and we won't know that for a number of months to come. Secondly, we have these fabulous maps produced by Carolina Reed at the San Francisco Federal Reserve Board that really maps the concentration and geography of foreclosures. And I have a couple of sets of these, which I will whip through quickly. 3 stages here: September 2007, April 2008, and August 2008. And so we'll look at them quickly, and this is for the state of California. And then we go into April, and you see concentrations in the Central Valley, down through San Bernardino, Riverside, some in the LA area, down in San Diego, and then again, a spreading like a virus, really, of the darker coloring being the increasing levels of foreclosures. Now, a little bit more detailed look of this in the Bay Area, where the pattern is really quite interesting. It is a mix of the traditional foreclosure hotspots of low-income minority communities and the outlying suburban areas where people were going to find affordability. So this is kind of a baseline. You still see some beginning activities in the Central Valley communities. These are still in the sort of the commuter shed of the larger Bay Area in many cases. This is April 2008, and then August 2008. You see just a map of red that is really devastating many of these communities. I should say I was at an event a couple of nights ago in Antioch where we had 500 people packed into a church who were looking for solutions to their foreclosure problems, mostly Latino. Just a stunning impact on the communities. And Antioch, I think the mayor said that 1 of 10 houses in the community were in the foreclosure process. Increasingly, the markets are dominated by foreclosure sales. This is data from DataQuick. Nearly half of all sales in California are now associated with foreclosure sales. So we have record levels of problems. We're moving towards a second wave, at which Ms. Yellen mentioned at the outset, with the Alt-A portfolio. That is particularly concentrated here in California. The colorations here you can see as the green bars decline, as the subprime market gets resolved, you see this large blue market here, which is the Alt-A portfolios, where defaults and foreclosures are rapidly increasing and will actually reach crisis points out between, say, May of 2010 and January of 2012, as the option arms and other Alt-A products that have reset dates face really cataclysmic payment shocks that will force some resolution. I will say that if you look at this graph here, this is just for option arms, and 60% of all of the option arms are here in California. Credit Suisse did this original projection last year. Then about 4 or 5 months ago, about 3 months ago, they updated their projections. The gray lines show that the shift in these defaults are happening earlier now, and borrowers in option arms, 80% of them are making minimum payments on their loans, and they are defaulting in record numbers even before their loans recast. When the loans recast, they are facing all of their options go away, and they faced fixed rate amortizing payments that are 50 to 100% of what their current payments are, which will essentially be unpayable. Okay, so that is sort of one of the reasons why I am confident that we're going to see a second wave of foreclosure challenges out into the years to come. As I said, California, because of its high costs, because of aggressive marketing, these Alt-A products, the option arms, which offered extremely discounted teaser rates, were very, very attractive during the boom days of 10, 15, 20% housing price appreciation. The loss projections are as severe as Paul laid out. When you look out, Lehman and S&P are looking at just extraordinary levels of losses, 50 or 55% of the outstanding option arm pools. And just to sort of put a point on it, if you look at the lenders who are popularizing these option arm products, WAMU, Wachovia, IndyMac, Countrywide, they all have something in common, which is they are no longer in their existing form. This was a dangerous and devastating product, popularized and made more dangerous by the securitization process that we had and the lack of protections that was in those securitization process. Neighborhood effects, we all know about. We did a report that shows that in California, the loss of wealth extends well beyond the people who are losing their homes, driving down prices, causing crime and blight in communities. Loan modifications, we believe, are the best answer, but to date, the voluntary efforts, including those promoted by Hope Now, have come up substantially short. These are the data from California, which make the very simple point that even as yesterday the governor announced an increase in modifications, that we see the green bars are the modifications, the yellow and the red bars are the defaults and the foreclosures. You see that the modest increases that we're seeing in modifications aren't keeping pace with really the fire hose growth in defaults and foreclosures. And we need some greater, more systematic way that Ms. Yellen talked about to deal with this problem. Here we have another presentation of this that looks a little bit more at the Hope Now data. I don't know if you can see this back there. What we know of modifications to date from the limited research that's been done is that half of the modifications haven't actually ended up reducing the borrower's payment. So it's not surprising that we have seen higher levels of redefaults associated with those modifications, in part because the modifications have been treated the way loss mitigation efforts treated foreclosures and defaults 5, 10, 15 years ago, which mostly was a short-term disruption in income rather than a core underwriting problem and a design problem in the loan. We have a lot of short-term repayment plans, which we don't think are going to provide long-term relief. And then we show here that the Hope Now actual modifications, about half of them are reducing payments and half of them are not. There are some substantial structural obstacles to doing loan modifications. We nod our heads here, but there's a nod of agreement. Paul mentioned one about the second liens. There are a long list of them, really. The insufficient servicer staffing, the servicer shops were not equipped to deal with anything near this kind of tsunami of defaults and foreclosures. They've tried to staff up, but one of the big obstacles, I would say, is lack of technology. For most of the last 20 years, we've had huge innovation in automated underwriting technology, and yet the process for doing loss mitigation is what I would akin to 1970s loan origination. It's labor-intensive, staff-intensive, one by one, and it's just not able to keep up and process the flow that's coming in. You have financial incentives that are askew because servicers aren't paid bonuses for modifications, where they're automatically recovering any money that they put out for foreclosures. They have risks of investors' lawsuits. There are limits to pooling and servicing agreements. There are these second loan problems, the piggyback seconds, which are a very, very serious obstacle. So the answer here is trying to get beyond this loan-by-loan approach. There are a couple of innovations in the marketplace, or semi in the marketplace, with IndyMac. Sheila Bair, the head of the FDIC, has taken over and introduced this new program of a systematic loan modification process geared towards affordability for homeowners through a combination of interest rate reductions, extensions of term, and rather than forgiveness of loan principal, forbearance of loan principal, which actually has a sort of a hint of the equity sharing or appreciation sharing. So we're not giving up the loan balance. We're not giving it up for the investors. If there's a future sale or a future refinance, you can collect on that, but it's lowered for the purpose of calculating an affordable payment. And most recently, the Bank of America settled a lawsuit with Jerry Brown and a number of other attorneys general, where they agreed to set up a slightly different but a similar designed affordability systematic-driven system for providing loan modifications for borrowers. When they were accused, I should say, when they were accused by the AGs of systematically providing, of using unfair and deceptive practices in the marketing of hybrid arms and option arms across the country. That was the countrywide accusation. And in reviewing that suit, that was fairly systematic of the subprime lenders and other lenders offering those products across the country. Was not at all limited to countrywide. So we have a number of new tools. Paul talked in some depth about the Hope for Homeownership program. It's just come online. When we're facing projections of 6.5 million foreclosures through 2012, CBO's projections of 400,000 potential folks who could benefit, it's really a fairly narrow approach if it is successful. It's still a voluntary program. Lenders are going to have to be willing to make these loans, and the investors are going to have to be willing to do the principal balance write-downs, which at this point remains a very substantial question mark. The previous bill in July also included some neighborhood stabilization funds. About $530 million has been allocated to California to help states and localities purchase and improve foreclosed properties to address the problems of concentrated foreclosures. They also provided an extra $1 billion of tax-exempt bond authority to be used to potentially refinance borrowers or to help borrowers get into homes. Unclear whether that's going to work. I don't think anybody anticipated that the bond market would shut down, and thus the ability to offer and issue these bonds in any reasonable term is somewhat in doubt at this point. We are, as many are, quite sort of distressed that the TARP program, as it's moved forward, first of all, wasn't in its design more focused on assistance to homeowners. As previous speakers have indicated, you know, the focus. We believe it should have been focused first and foremost on the housing markets and on homeowners, and that was not the principal focus. There are a number of strategies that can help homeowners both within the existing TARP and on the horizon. I'm going to sort of whip through those pretty quickly. First of all, we think within the existing authorities that the Treasury Department can be more aggressive in putting conditions on the recipients of TARP resources, whether that's through capital injections, whether that's in any future asset purchases. They could require that those entities in exchange begin to adopt a systematic loan modification program, such has been adopted by the by IndyMac Bank under the FDIC's auspices. They can do a guarantee program. Rumors are that FDIC and Treasury are close to announcing such a program that could have a $40 or $50 billion price tag. We are anxious to see how that plays out in the next few days. Certainly, if there is an asset purchase program, the criteria for selecting which assets to be purchased could be filtered through a lens of which ones will facilitate loan modifications. So they could focus on buying portfolios of second loans, which would take away some of the problems with the barriers of second loans. Or they could buy the servicing rights so that they would have more control over these. And finally, I have been struck at the lack of transparent reporting. Hope Now data reported by the Department of Corporations, none of that data, all of that data is reported on an aggregate basis, none of it is reported on a loan level basis, and none of it is reported on a servicer level basis. So we can't really see or track which companies are actually leading the way and setting the standards for loan modification efforts. There are a number of additional potential legislative changes, including bankruptcy reform. They're changing of the REMIC rules, which were referenced about how hard it is to buy loans out of existing trusts. And maybe in the event of a public purpose, such as loan modifications, legislation could be put forward that would modify those. We could incentivize servicers by paying them cash bonuses for doing modifications. We could indemnify them from investor lawsuits. There are a number of options that are in play and in consideration, and we certainly hope that with a new administration that some of these additional provisions will be considered. And finally, there is the controversial proposal to lift the ban on court-supervised modifications. I would point out that under our current bankruptcy law, the principal residence is the only asset which a bankruptcy judge cannot redo the terms of. And we think actually just changing this little tweak in Chapter 13 of the Bankruptcy Code provides a no-cost solution that will help as many as 600,000 homeowners save their homes. The proposals that have been before the Congress have been narrowly targeted, and they would allow bankruptcy judges to evaluate the case from both sides as a neutral arbiter, as it were, to determine whether or not you could provide a long-term affordable modification. As it is now, borrowers are relying on the goodwill and the decision-making of the servicers in order to do that. All of these are voluntary. The bankruptcy route opens up a mandatory route, which we think could be critical in accelerating the numbers of loan modifications. Thank you very much.
Okay. Okay, well, thanks to the organizers for letting me come and speak today. I'm enjoying the program thus far and look forward to the other sessions. What I'd like to speak about today is the changing roles of bank and non-bank mortgage lending that we've observed over the past couple years. So we've heard many times so far today about the importance of house price changes in explaining what is taking place in housing markets more generally, but also mortgage markets and mortgage lending. And when you think about when those house prices peaked in a lot of these markets. That was about 2 years ago, particularly right here. So we've actually had a lot of adjustment that's taken place in housing markets and in mortgage lending markets. So I actually think it's kind of useful to look at where we are right now in terms of the structure of mortgage lending when we think about where it will be in the near term. Certainly, right now it feels very different than it was than it felt maybe 1 year ago, where the future seem very uncertain. So that's the tact I'm going to take here with this brief talk. So specifically, what I'd like to do is to talk about a little bit of research that we've been doing at the San Francisco Fed, and sort of talk about the changing roles that we've seen for bank and non-bank providers of mortgage finance. And so what I'm really talking about is sort of the old-fashioned mortgages funded by deposits and ending up on a financial institution's balance sheet versus the originate to distribute model, where financial institutions were just getting in there, originating mortgages and immediately selling them into the secondary market. And as we've heard in detail already, that latter model seems to have broken down a little bit. So one of the objectives that I'd have here is to try and quantify the extent that it really has broken down. So I'm going to show you some evidence on that. I'd also like to look at what the implications for that breakdown are going to be, both in terms for borrowers, the people who are benefiting the most, I think, from this originate to distribute model, and then also in terms of local markets. We'll look for some signs of recovery. There aren't any yet. That won't take long to get through, and then I think in truly looking forward, again, we've heard this already today, that it seems like there is an increased hope and reliance that financial institutions are going to get out there and start making more loans, to the extent that there is a shortfall of credit being provided to the economy right now. And I'm going to speculate out loud on whether that's going to be likely or not. Okay, so here are some data trying to get at the picture that we've been looking at. So these are data for new loans and where these loans that in this case are made in California, originated in 2006, and where they actually ended up. The data come from this data provider, McDash Analytics. So again, just new loans here. For California, the choice here is this is just an enormous data set. We sort of need to wrestle it into a shape where we can actually use it. So we're just looking at California here. Part of that is reflecting, this is in our region, so we're interested naturally for that point of view. But also, California is just so diverse economically in terms of like the housing market. All the factors that are contributing to the dynamics in housing markets in aggregate, they're all in play here. So this is a good place to look. So in 2006, about a quarter of the mortgages that were originated ended up with the GSEs in some form, either in their portfolio, their retained portfolio, or in an agency securitization. Now, private securitizations, which we were hearing about earlier, so about half of the originations in 2006 ended up there. So this is a really big part of the California lending market. So lender portfolios. Now these are not necessarily banks. These are just financial institutions. They had about 18%, and there's some other category. These don't sum up to 100. So clearly the private securitization is important here. Now we can look a little bit more closely at just who who is it that is getting a loan that ends up in a private securitization? And a lot of this stuff, you sort of kind of knew it already, right? I mean, these private securitizations were absorbing a lot of the higher risk lending that was taking place over this period. So, lower credit score, higher LTV loans ended up in these private securitizations relative to in a financial institution's portfolio. I'm in this analysis here. I mean, there's sort of a model behind this this analysis, and I'm just dropping all the GSE stuff right here. This is all just relative to holding it yourself. What kind of loans? What were the determinants that made it more likely that you ended up securitizing the mortgage? So higher risk loans, loans with less income to spare after the mortgage had been paid off. But also, I mean, again, we're talking about half of the market here. It's not just the risky half, but also loans that were large. This is the jumbo market that's being serviced here. Loans made in markets that had a lot of past house price appreciation, and then controlling for that house price appreciation. You can kind of dig down and look at the census tract levels. That these are loans getting made in census tracts that tended to be high income and high education, sort of associated with places where the people with high permanent income might be living. So again, this is a very important part of the California mortgage market that's servicing both the higher risk and possibly just the more expensive part of the housing market. So it is still important, maybe not for quite the same reasons I was just alluding to. So when we actually look at delinquency rates, it looks like we really are getting a very different experience with the privately securitized mortgages, and this is turning into be a huge problem. So part of our work has been trying to explain this gap. I mean, it's just enormous that loans that ended up getting securitized have delinquency rates. So as of the third quarter of December, they were twice as high as the loans that were retained in a lender's portfolio. And I just sort of finished up saying that these loans had different risk properties, even controlling for these different characteristics as best you can. You can work down about half of that gap, but the fact remains that there are really different delinquency outcomes for these types of loans, and accordingly, you're getting a pretty big reaction to that in markets right now. So I'm sort of updating this the market structure for California again in 2008 through August here, and you can see the structure has just completely changed. The GSEs are accounting for the majority of the lending here. The private securitization channel has all but shut down in 2008. So now the lenders, the lender portfolio share is about the same, but again, there's been a big reduction in credit extended right now. So they're keeping the same share of a smaller pie. So the hope is, of course, that these guys are going to be able to step up a little bit and lend to this market that seems to need credit. Now, there do seem to be significant headwinds that are going to cause the banks maybe to think twice about lending into this market. So Janet Yellen was referring to this point earlier in her speech. This is kind of like the data appendix to her speech right here. So these are the seasoning curves where we look at the rates at which these loans are going delinquent by vintage. So if you just sort of read off these are loans that are originated in 2004, and 45 months out, almost 4 years out, they have delinquency rates, serious delinquency rates of 1.5%. So 2004 was a good year. 2005 was worse, and it just kept on getting worse over time. But the point that we'd like to make is 2006 here. This is when we thought that underwriting standards had really reached a bottom in terms of riskiness. By 2007, certainly the second half of 2007, we sort of knew what was happening, right? And the banks were tightening up. And yet look, their delinquency rate is even worse on those loans. So lenders are getting surprised on the downside. They are tightening, but the economic conditions are well, they're not improving, to put it mildly. So that's certainly one headwind. Now, when you look at what banks or what these lenders who retain the mortgages in their portfolios, what are they doing over the course of this period where this private securitization channel is shutting down? We can actually see that, I mean, they are tightening up terms in a pretty big way. So this is a distribution of the FICO scores on the loans that are accepted. In blue is 2006. Red is 2008. So I mean, there's a big rightward shift. The low FICO score loans are just becoming less and less prevalent. And there's just outright rationing taking place. We were hearing about option arms. There basically aren't any option arms that are being originated in California as of this time. So just to wrap up, when we look at what has happened over the last couple of years, there's been a lot of destruction in value. So we read that in the newspaper, but it seems to be localized in the mortgages that did end up in these private securitizations. And as a consequence, I mean, this channel is seemingly, I mean, it's damaged and is we're not getting as much credit coming through that pipe right now. But when we turn around and sort of look at, well, are the more traditional type lenders going to step up and replace that kind of lending? The evidence at this point suggests that there is some resistance to that. So, thanks.
So we have time for a few questions. So if there are questions from the audience, go ahead, Tony.
I'd like to ask Mr. Blackwell whether it wouldn't make sense to restore confidence in the people who are investing in mortgages, to have the originators retain ownership of 10 to 15% of any securitized issues they make, and especially from the bottom tranche, which gets the last payment. Wouldn't that be a way that, since the credit rating agencies have lost all credibility, the lenders who are putting out the money might have more confidence that the originators would pay attention to the quality of what they're doing if they had to hold 10 to 15% of the mortgages themselves?
You know, I think I think that's an idea that should be considered. The key issue you'd want to make sure we took into account was what would that do to the availability of cash available for mortgage lending. If it created too high a barrier of entry, for example, for lenders to make loans, or if it required too high a capital use so that there wasn't as much mortgage money available, I think that might not work. But if there is not, no, I know. So we're thinking long-term here, not today. But you also wouldn't want the lender that originated the loan to have the first tranche of losses because if you did that, then the credit guidelines would be extraordinarily tight. There'd be virtually no reward to that lender for making those loans if they were to realize the first losses. I think you would want to spread the loss across the entire mortgage itself.
I'd just like to add to that, if I could. You know, I think there are a lot of misaligned incentives, and the spirit is right, but you mentioned the rating agencies. What if we paid the rating agencies differently? Instead of a fee up front, they got paid a fee over the life of the deal based on performance versus what they projected.
I think that's one good idea, and also they should be paid by the lenders, not by the people who are selling the securitization to the lenders.
Yeah, right.
You know, it's also important that the lenders that are doing the best originations over time are the ones that get access to the lowest cost of money, therefore rewarding them in market share. It worked exactly the opposite during the last cycle.
Yes?
Wait, I have a question. I wonder why the commercial bank tightened the criteria for a loan. Just for example, one of my friends, he's an individual investor. He wanted to get a loan from Wells Fargo for a property in Vallejo. That property was sold 2 years ago at a price of $300,000, but just right now the price is $700,000. It's pretty cheap, but he was refused by Wells Fargo. The reason was because he has already owned 9 properties. But it sounds ridiculous for him because he has already anchored a lease to buy a tenant. So why?
You said he owned 9 properties?
No, not me, my friend.
I'm sorry?
Yeah, one of my friends. Yeah, he's a
No, your friend owned 9 properties.
Yes, 9
okay,
properties.
Yeah.
But he has already anchored a lease to buy.
Right. He currently owns 9 properties. Yeah. So there are a couple things. First, I think that the work that you saw from the Federal Reserve that suggested that delinquencies are still on the rise even on most recent vintages would suggest that there are still many concerns that lenders are going to have in originating their mortgages. Now, your friend's loan, I don't know, I can't speak to it. There are different sets of guidelines based on whether the loan is being sold to FHA, the GSEs, or held in portfolio. There is, of course, no securitization available for private securitization. And the GSEs have very strict guidelines on number of properties owned, mainly because the more properties a borrower owns, the greater likelihood that they, all those properties could go down. And that's probably the reason that that occurred. I think we're seeing the GSEs not allowing any more than 4 properties, and as a result, most private lenders that are using portfolio money are not allowing more than 4 properties to prevent any adverse selection from occurring. They get all of the higher risk loans onto their balance sheet.
So one more question.
My question is, what ought to be the optimum home ownership rate in America? Because the higher you push it, the more subprime lending you end up getting.
Does anybody else want to take that?
Yeah. Is there an economist in the house?
I'll tell you what, that in fact is the $60,000, trillion dollar, the multi-trillion-dollar question. In that, it seems that the issue is that everybody should be allowed to be a homeowner, but everybody shouldn't be allowed to be a homeowner today. We need to educate people. We need to ensure that they have the capability to repay the mortgages. And I think we have a lot of work to do as a country and as financial institutions, government, community organizations to find ways to provide people the means for home ownership and thereby drive home ownership rates up, as opposed to the last round where what we did was we drove home ownership rates up by simply making mortgage money easier. It was easier to buy a house than it was to rent a piece of property. And let me tell you something. Have you ever heard the saying that nobody ever washes their rental car? Well, if I have less risk in buying a home or less of a hurdle to buy a home than I do to rent a home, what is the chance my commitment to stay in the property is there? So we need to provide a lot more support for getting people into homes and doing it the right way.
Can I just add I mean, I think we also need to be careful about throwing the baby out with the bathwater. That in this context, there have been many who have suggested that by the weakening of standards that homeownership is not appropriate for any low-income people. And that, I mean, I work for my parent organization is a national community development financial institution that has been involved in promoting homeownership over historical standards. With safe, responsible, prudent lending, homeownership is the key to lower income households entering the middle class. That's with a 2 or 3% historical appreciation rate in housing prices over the long term. And we have been doing it. We've been doing it with very low losses. Banks have made loans to lower income folks through the Community Reinvestment Act with very low losses, and that we shouldn't sort of ignore and get rid of the idea of promoting home ownership for low income people. We should make sure that there's responsible lending and sustainable loans for people to get into home ownership, but not tighten up the credit to the point where low income folks are denied access to home ownership.
And by the way, we absolutely 100% agree with that position.
So if you join me in thanking this very excellent panel.